Welcome to today's event, Intermarket Analysis, charting second half trend and direction.
We believe that all of these climate issues continue to be one of the topic, and also how would all of that also affect other commodities, including critical minerals.
We see a sign of global investors losing faith in the US dollars. I think this last thing is the most important thing for us, especially in Indonesia.
Next, we will hear from our first speaker, Mr. Wong Kon Hao from CME Group. He will discuss the market dynamics observed in 2024, where US stock markets, gold and Bitcoin posted significant gains, reflecting investor focus on inflation concern over the growth of potential AI. As we enter 2025, bonds started on a negative note, reinforcing the view that last year's focus on US stock, gold, Bitcoin as well-founded. In this session, Mr. Wong Kon Hao will examine the interconnection among these key markets to uncover valuable insights and develop effective trading strategies. Please, Mr. Wong Kon Hao.
Yes, first of all, I want to thank you, the MC, and I want to thank two very important people. If not, I won't be here to have this opportunity to address or discuss about this topic. The first one is Park Rahmat. To me, he's a very dear friend and very key person of CFA Society. Okay, the other second important man to me is my partner, CME Group, Mr. Harry Yeo. So thank you for having me. And also, it's such an honor to really, together with you, Park Pahala and Masuri, and also Park Edwin and Ridwan. It's such an honor to be seated with you together side by side earlier. We have such a great discussion. And definitely with the rest of the panelists, very distinguished panelists and speakers, and not forgetting all those that are present today. It's such an honor to be here. Now, let's get started on my presentation. To be here to share insights of what's happening is quite challenging right now, I believe, for even Park Edwin just now. Why? Because what we can prepare 2 weeks ago, it may not be relevant today. Things are so volatile and keep on changing. But I'm glad that when we designed this topic about the intermarket analysis, charting second half of the trend and direction, the team is making sense of the current chaos. And this topic was designed before the Liberation Day. And we knew that with President Trump, the world will be in chaos. So we have to design and look beyond what's going to be coming weeks or months. So we planned this topic that it could last us into the end of this year and perhaps beyond 2025. So this is what we have in mind. So this will be the key topic for today. And again, this is not investment advice. So what I'm going to share for the next 45 slides is honestly for my own consumption. Yeah, it's not for you to follow. So if you want to follow, is at your own risk. Of course, there are some brokers around. Ray, from DBS Speakers Balas, please look for him. Or Tommy, please look for them. They are licensed broker over here. So at your own risk. And just want to share a wonderful news about the honor that I received last year in 2024 was being awarded as a Trading View Wizard. I do not know what is that, but on checking, I realized such an honor to have that from US, that I'm one of the 3 wizards that was being awarded in 2024. And in Asia, there's only 3. One from Turkey, I believe, the other one from Korea. And I hope that in Indonesia, we can have a Trading View Wizard as well this year or in some years to come. Now, let's get started with the key topic here today. Which market has been moving up the most lately? Now, let me just give you a time frame, because this framework is important for us to understand, to discuss about the intermarket analysis. There's 2 main markets. Now, my question to you is, which market moved the most on the upward trend lately of the last 3 years? Let me be very specific. That means the last 3 years, this market has been almost continuously moving up. I think this answer is pretty straightforward. You may have already know the answer. It is gold, the last 3 years. That we could see that since Later, I'm going to describe about June 2022, but it in fact started moving in March 2020. We're going to discuss why. This is important for us to understand what is going to be bring forth for the rest of the year, 2025, and even beyond that. Now, the next question is this. What is gold telling us when it moves up? Why? Why gold has been moving up since the year 2020? I think all of us will have a clear understanding. When gold starts to move up, it also represents that there's this perceived inflation may come. That was way back in 2020. Even today, that we could see since the year 2022, every year by now, the central banks around the world are the biggest investor in gold. Then you've got to ask yourself, why are they investing in gold and accumulating in gold? Are they saying that inflation are going to continue on the upward trend? So later on, we'll discuss about, will this upward trend continue? It also means that, will this inflation continue? It's not just in Indonesia, but all over the world, which is very important to address this question, because once we have this answer, we will know that the continuous upward trend for gold is still there. Now, let me ask you the more challenging question here. Which market has been moving down the most lately? Let me just give you a time frame. The last 3 years. Any answer from the floor? Which market has been moving down the most almost consistently for the last 3 years? Now, let me just give you a hint. From especially the year 2020, 2022, and from 2022 to current, all this 5 years, you have moved down by 44% continuously. Any clue? Oil? Okay, let's check it out. Is the US bonds. It's just amazing, isn't it? US bonds was one of the biggest market in the world before the US stock pickup. The largest cap, but not many people talk about it. If you look at in the same period where gold bottom and started to move up in March 2020, in the same month and same year in 2020, March, the bonds have peaked. And from this peak to the recent low, and that low was in 2023, and now it's still staying that low, it was down 44%. You know, since 2022, together with CME, we moved to places. We've been talking about the US bonds. But I noticed even in year 2022, not many people are taking notice that bonds is under pressure. It is only the last few weeks investors around the world start to pay attention to what's happening to the bonds. Especially on Sunday, that Moody's started to downgrade the US bonds to AA+. AA+ also means that bonds are on a neutral ground. They have no idea is it bullish or bearish. This is what they're trying to imply. Now, the next question is this, before we discuss about will the bond continue this downward pressure. So when bonds start to move down, what is it telling us? I won't ask you this question, but think about it. So I always be very inquisitive when market move in the extreme end. I got to ask myself, I hope you can do the same with your fund. Ask yourself, what is the market telling us? To me, when the bonds start to move down to 44%, it is telling me that it is a trust issue, that the global investor are losing confidence and having the trust in the bonds. Now, we're going to address the next question here is, will this downward pressure continue? That's even more important. Okay? So this is the two main markets that we're going to discuss, and we're going to form a lot of opportunity moving forward. The gold and the bonds. I just want to take this opportunity to congrats CME Group. I think their think tank is just remarkable. They have this micro E-mini indices across in 2019. Somehow I just felt that their think tank are brilliant because when they birth off these products means they can hedge into the US indices. That's what it was in the year 2019 before COVID. Then 1 year later, or less than 1 year later, we have COVID, and the stock market collapsed. So a lot of traders, hedgers, fund use this product to hedge into the US equity. And especially the option market, whenever I look at the option volume, it speaks to me the hedge activity has increased. Now, whenever the option volume pick up, it means that the fund houses are turning attention to hedging. Now, if you look at the S&P option average daily volume, you could see that in year 2022, the volume picked up tremendously. It also speaks to me that the fund houses are using option to hedge into uncertainty. Now, what happened to 2022? It was when US inflation hit a high of 9%. And during this period in year 2020, you could see that the volume also picked up. That was during COVID years. And even today in 2025, that the volume have picked up tremendously. What does it tell me? It tells me that the fund houses are hedging tremendously in this market. So we have to take note of that. Now, earlier we discussed about what is gold telling us when it moves up. That means they are seeing that central banks are seeing that inflation is still going to continue to stay on this high. But the question is that, will the gold continue to move up? I think that's the key question. We're going to discuss that. Let's look at the gold market. And in the midst of designing this presentation today, it's always out of inspiration and passion that you have in the market. Things will always drop down as inspiration. I came up with this matrix to help myself. It's called a QTD. Now, Q, it means that as long as quantitative easing is still there, in a time of uncertainty, the next crisis, I think gold will still go up. Then T stands for tariffs, the tariff trap. Do you think that the tariff will be ongoing? If the answer is yes, I think the gold will still go up. And the last one is the debt, the US debt. Do you think that the US debt is going to continue to climb? If the answer is yes, I think the gold will continue to go up. And that's became the trio. When the trio come into play, I think as an investor, we have certain confidence on where is the general trend of the gold market. Now let's look at the first Q, quantitative easing. That we can see that in history, of course, that's 1971 where the Nixon shock, where President Nixon announced that gold is no longer pegged to their US dollars. We saw it went up, but for the last 20 years, from 1980 to the year 2000, gold has been generally very stable at about 200 to 300 range. Now, the first QE in history, in the modern history, it was by the Japanese. That was in 2001. There we can see, of course, what is QE is we all knew that the central bank print money and buy their own treasury. So when that happened, gold started to move up. And it was a very successful campaign because it was first in history. And US studied that. And when US had their crisis in 2008, they thought that since they have a successful launch of QE by the Japanese, they should do the same as well. So they did it in 2008. We have QE 1, 2, and 3. And we saw how the gold has climbed. Then it comes stabilize with the quantitative tightening. Then there comes the COVID. And this time around, the Fed have robbed big time on the QE called the COVID QE program. And we saw that how gold have escalated. Now we have to see this relationship between QE and gold. So the next question I got to ask myself is this. In the next crisis, it will always come. Crisis is good. If you do not know how to manage it, it's bad. But we have to see beyond that. In every crisis, there's risk. Yes, we have to understand that. That's why we're here. But when there's risk, there's always opportunity. So I've got to ask myself this question in the next crisis to come. Will the central bank continue to rock QE? And my answer is likely a yes. Now, if this is true, then I think gold will have a chance to continue this upward trend. Now, let's take a look at the next slide. The T. Now, T is something new, tariffs. And tariffs started in a big way during President Trump's first term. And that was in the year 2018. Now, I could literally see that the first QE started in 8th of July and August 2018. Now, you could literally see that how gold has pivoted at this low on the announcement, and it started to move up, and from there it started to move up. That's for the gold market. Then when President Biden took over, basically everything remained the same, but he did something. In October 2022, the tariff was export control on advanced chip. And on the announcement, you could see that how gold has pivoted at the low, and it started to move up from here. Now, the next pivot on tariffs is when President Trump won the election between himself and Biden. That was made known in November last year. The moment we got the news, let's look at how gold has pivoted, because we know that he's going to come in again with Trump 2.0 tariffs. So, and that's what we are seeing here. Now, the next question is this. We are now here. We got to ask ourselves, if the tariffs is going to continue to happen, and if your answer is yes, now based on this case study, I would say that likely there's a chance that gold will continue to move up. Now let's study the last one, which is the D. It stands for debt. That if you look at this relationship, the debt over the last 50 years, yellow is the US debt, we could see that gold has been trading along the US debt. So again, we got to ask this question right now. Is the US debt at 36 trillion by right now? Is going to be continuous? And my answer is likely the US debt is going to continue to move up. So when this trail happened, the Q, T, and D, we've got to ask ourselves every quarter, every year, we got to take accounts. Where's the Q, where's the T, and where's the D? Then we know that once we know where the main direction is going, in the turbulence, the daily turbulence, weekly turbulence, monthly turbulence that's always there, we will not be shaken. We will have a clear idea where the main trend is. Let's look at another significant point in history. So we discussed about March 2020. That was the QE, COVID QE. The next important year to take note is June 2022. What happened to June 2022? It was when inflation hit a high of 9%. This is exciting. Now, the next question is that earlier we discussed about what is the bond telling us when it starts to move down continuously. We discussed about trust issue. Now, it's also important to address that will this downward pressure in the US bonds continue? Now, these two dates to me is set the foundation of this understanding. Let's discuss about what happened in this two very important milestone for the bonds market and the global market, which is the year 2000, March 2020, and also June 2022. Now I want to see that for the last 30 to 40 years, this is a US bonds, it has tread this very nice uptrend line, almost like a straight line ruler. If you look at the historic, from this low, it met at the lowest point. This guy met at the lowest point here. This was a false break, lowest point, lowest point, lowest point. There were many lowest points here. Now, so we saw that March 2020, that was when the COVID QE being rolled out. It was the peak at the point in time. Then when I was observing very closely about this uptrend line, I hope that it will not be broken. So in June 2022, that was inflation hit a high of 9%, but unfortunately what I saw is that it broke down this very major uptrend line, this major support, without hesitation and with great transaction volume. That's frightened me. Then I know that this trend may not hold. That was a time in June 2022, I have kind of have an affirmation from the market that the bonds is going to continue its downward pressure, technically and fundamentally, as we could see. And today we could see that the bonds are trending on this channel very nicely, and that was the Liberation Day tariffs announcement on 2nd of April. Now, why this 2 days is very important, let's study about during the year of COVID. Now, we could see that the first QE that was being announced, that was the year 2008. It was 1.3 trillion US dollars. Now, we have to understand that there's a good debt and a bad debt. So back in those years, they continue to print money and buy their bonds. Those are good debts. As they borrow and expand to expand their economy, those are good debts. But when come to a point of, if you continue to do that, the debt will not be sustainable. I wouldn't use the word bad debt, you haven't reached that point yet, but I would say that at this point, the debt is unsustainable. That became a danger. Now, but what happened to March 2020, it was, now look at this amount compared to this, from 1.3 US dollars trillion to 4.8 trillion US dollars. And I can say that the investors do not like it because they know that debt is good, but you have too much debt that it doesn't equate, there's no equilibrium to your output of production. That's bad, that's unhealthy. So investors do not like that. That's why you can see that from March 2020, the bonds have peaked. Now let's study about the inflation. And this was the CPI. That we could see that over the last 50 years, the CPI. Let's look at the trend right now. The inflation has been on downward slope for the last 40 years. But what happened to June 2022 was, for the first time in history, that the inflation have broke this downtrend line without hesitation. And that, to me, is a danger. When this happened, technically, I would say that could it be the first wave, second wave, and we're heading for the third wave. And looking at the fundamental development, the macro development, it seems like there is likelihood the third wave may come. That even for Walmart last week, he said, or they say that he warned Americans that they are going to pay a higher price because of the Donald Trump trade war, despite the a successful negotiation between the US and China. So we know that inflation is real. And I do suspect that the third wave is still in the making. We cannot rule out the possibility. So you have to look at these 2 days have shaped the market main direction in all fronts, whether it's bonds, the US stocks, the commodities, even to the stock market. And I totally agree with Park Edwin that when there's risk, we could see that there's fund flow into Asia. I'm so happy that for Indonesia that I could see that the rupiah has strengthened 3% when the Moody announced the downgrade of US bonds. Of course, I'm not happy with that, but in a way, I'm happy for Indonesia that the currency has strengthened 3% just by that announcement. Now, let's unpack everything. Where's the opportunity? Now, let me just break it down. And now, I try not to sound that in fact, I'm not a doom and gloom individual. I'm very positive all the time. Okay, but we know that the debt, it became unsustainable. It's not bad at this point in time, it's just unsustainable. So these 2 days is important, March 2020 and June 2022, and we may be at a tipping point right now. Now, 10 years ago, of course, we heard about, many people share that the bonds may collapse, the US market may collapse. We heard that 10 years ago. I think we also heard that 20 years ago. And the first time I heard that the US is the greatest debtor in the world, that was when I became a teenager, when I was 13 years old, exactly 40 years back. It's from my Indonesian classmate back home in Singapore. And 13 years old as a teenager, he said that US is the greatest debtor of the world. But nothing happened because they were engaging in good debts, using debt to expand the economy. But come to a point that will be a tipping point. Of course, the million-dollar question is, when is it? Could it be this year? Could it be next year? Now, I can use these 2 important dates to kind of figure out March 2020 and June 2022. Now, let's continue to explore on what's happening. Now, to me, to understand about debt is a very simple mathematical calculation. When debt rises, without an equilibrium to your output in production, it also means that the currency will be weakened in terms of US dollars. Now, when your currency weaken US dollars, it brings currency dilution. When currency dilution, it also means that inflation may accelerate. So it's simple math. Too much debt, your currency be weakened. And with currency weakness, inflation will come. And that's why all of the world, we're experiencing inflation. Not just in Indonesia, back home in Singapore, in Malaysia, we're experiencing inflation. Because those who's responsible for printing money, they have export their inflation to all over the world. Inflation can be exported. Yes, inflation can be exported. Now, let's look at a currency that is very strong. So we've got to ask ourselves, is US dollars weak at all? US dollar is not weak, but to me, US dollars is very weak. So if I got to compare to a developed nation in US, I have to compare apple to apple. Let me just compare US dollars with Swiss. Swiss total debt, accumulated debt, last year was 360 billion US dollars, less than that. But US accumulated debt is 36 trillion US dollars, still on a climb. But of course, we can't just compare the amount, but we have to compare their debt to GDP ratio. But you know the answer. But let's look at the dollar Swiss to equate out, is the US dollar is really that weak to a strong economy? We could see that over the last 50 years, the US dollars compared to Swiss have depreciated by 5 times. 5 times means 500%. Can you see that, the weakness in US dollars? And last year, in April 2024, I was with CFA Society at a Japanese restaurant. So we share about the direction of gold in relationship to US dollars. That we believe that the dollar index will continue to move down. If dollar index continue to move down, US dollars continue to move down, it also means that the gold will move up. So we study into the relationship that gold is a currency. When US dollars down, gold will move up. That was in April 2024, exactly about 1 year ago. Now, April 2024, dollar index was at 105. So I'm expecting that the dollar index to continue to come down. If that happened, then gold, just about more than 1 year ago, gold was at 2003. When US dollars come down, it means that gold will have a good chance to continue to move up. And that was what we have discussed. So where is gold today and where is US dollars today? Now, I want to zero in on this figure, dollar index 105 and gold at 2003. So we could see that today, the dollar index from 105 has moved down to about 99, and gold from 2003, it went up to 3,500 US dollars. So last year we studied the inverse relationship between the dollar and the gold. As long as US dollars move down, we could see that gold move up in every cycle. And we saw an interesting phenomena here between the US dollars and gold. When US dollar moved down 66%, gold moved up multiple folds, 600%. When US dollar moved up 46%, gold came down equilibrium. It means that based on this case study, when US dollars is down, the gold move up multiple times. This is based on study. Yeah. So I have to decode as gold in a very unstable world like this today, it became a currency against the US dollars. Now, I'm going to break this down with this very simple title, with that I will end. That what began well as a good debt, it grew risky. But in every risky situation, we understand that, to me, there's always opportunity. I want you to look beyond what we have read and what we've experienced. That I think is part of Asia or ASEAN, we are kind of experiencing it at the very beginning. I would say that I'm excited. There are many good days and years ahead to come. We just have to focus on the right assets. Let me just move on. How can we hedge? Now, we talk about debt and QE, where I believe that as long as debt and QE, remember the Q, T, and D, continue to be in place, the gold should continue to be on an upward trajectory. So, of course, you can consider to buy gold, or if you want to trade gold, usually when I have the main direction in place, I will also want to trade gold as well. So then I'll get myself engaged in the CME gold product, the regular gold or the mini gold, or recently they have launched a 1 ounce gold for retailer. Now, so as we move on, I also observe with increase of debt and QE, the currency, when I say currency depreciation, I'm referring to the US dollars, that I could see that beginning of this year, that the yen has moved up with a bullish engulfing body. Okay? You can hedge this uncertainty using the yen futures. That I could see that beginning of this year, there is this bullish engulfing body in the pound futures or pound dollar. That I could see that beginning of this year, very strongly, just between January to April, the euro has been moving up. And I saw that the Aussie dollar formed a hammer just about 2 months back. It means that it suggests that the market will continue to move up. When Aussie dollar move up, you also refer to the US dollars is coming off. And I also saw that the Swiss continue to move up just beginning of this year to now, and so is the Canadian dollars. And for the dollar offshore yuan, where CME also carry that product in futures, that I could see that it is having an inverted hammer. For this pair, is that when it starts to move down, it means that the dollar is down, the offshore Chinese yuan is moving up. That we could see that with debt, increase in QE, and tariffs still ongoing, the US dollars, it seems to me that starting this year is starting to take shape. That is my focus. On currency that oppose the US dollars, I will be looking very tightly, could it be a buy on dip opportunity? Once it starts to trend, I may want to hold on a little bit more. Now let's look at the next inflation numbers. The first time I came to CFA Society, it was September 2023. That was 1.5 years ago. Exactly here, I presented this chart. And I put a pause here because that was where we were, where gold is still below 2,000 US dollars. But then we discussed that there's a potential that gold will continue to move up. And I make this statement where I hold very, very true even today, that I say that as long as gold maintain a high point, the rest of the commodities will, according to their timing and their underlying reason, may move up. So gold is the leader of commodities. As long as it stays on a firm note, the rest of them, I will find opportunity to get into it when the reason is right. But what we could see here was, I freeze the timeline here. So crude oil, Park, you're right, it's not moving much, but the rest, soybean is higher, copper is much higher, cattle is much higher, hog is higher, corn is a bit more stable, coffee also went up a lot since September 2023. Yeah. Let's look at the yield. With that, there'll be a currency depreciation of US dollars. Commodities will start to move up. Then the yield will also start to move up. And what we're seeing here is a 40 to 50 years yield. 2 years, 5 years, 10 years, 30 years. Across the board, earlier we still remember we studied about the CPI numbers. It has broke above the 40 years downtrend line. How about the interest rate, the yield, across the 2, 5, 10, and 30 years? It has formed a very nice downtrend connecting all the dots throughout 2, 5, 10, 30 years. But in June 2022, it has convincingly broke above this downtrend. So my question to myself is that could this be a first wave, second wave in the making, and third wave to come? I think there's a possibility. So how you can hedge using the rising interest rate is CME have launched this futures about 2.5, 3 years back They have the 2, 5, 10, and 30 years yield futures. Now, next one, I think bond is going to be depressed. So earlier we discussed about the peak in March 2020, then it broke this downtrend line, and now is continuing to move on this channel. But let me just encourage you with this skill set here. Did I manage to pick the top in March 2020? Can I share with you this skill set? It can be done. Let me show you how to do it. I started making this plan in 2016. Okay? But a lot of opportunities, sometimes you just have to wait and sit on it. There's always a delay. Now, let me just share with you how I figure out possibly that bond may have peaked in 2020. Now, this was a case study that I shared in 2022. Now, way back in 2016, now this is a yearly chart. I want to pay close attention on this yearly chart. That you could see that in history, for the bonds, it has never formed this inverted hammer, but it did in 2016. So technically, I'm seeing something. Now, so earlier I explained that 10 years ago, I heard about those gloom and doom preacher. 20 years we heard about that, but I don't quite believe because the bond is still moving up. The interest rate is still low. So that's the basis. As long as bond is moving up, interest rate still low, I believe that the US stock market is still continue to be vibrant. But the clue that I have in 2016 was it formed an inverted hammer that I've never seen before in the history of the bonds. So I draw a straight line, I just mark it there. Now, in 2020, when COVID happened, it formed another not too classic inverted hammer, but this is a main resistance. I would view this as a false break. Now, where the real deal come to me that I have an understanding that bond may have peaked, it was in 2021, where I could see that there's an increase in selling volume. Not until June 2022, so I keep on repeating this date because I think it's in part of your muscle memory now. It's only in June 2022 it broke below this uptrend line. So that was the beginning of my campaign. That I continue to buy gold, I continue to watch out for commodities market may move up, and I believe that the bonds is going to continue to come down. So I hope that this is good sharing. Everything takes time. Yeah, so all these are technical studies, but you can see that how I gel it with macro analysis. It got to make sense. When two come together, it's perfect. Macro development plus technical analysis, this is where I build the confidence. Now, so this is volatile market, volatility in the stock market where we discuss about debt, currency, inflation, or commodities, rising yield, bond depreciation. Now, when all this happened, that was a case study I did during the first week of this year. Now, when I look at the monthly chart of December 2024, this was the first time I saw an inverted hammer on this parallel channel that I've drawn. Now, how did I draw this parallel channel is powerful, it's helpful to me when I analyze my macro development. That I drawn this significant bottom, you could see that how well it connect. That with this trend line, I find a significant historical peak in the past. When I project upwards, it was here. That was July last year, and that's December 2024, and I saw inverted hammer. So at the point in time, I kind of knew that technically that US market may have reached its top. And up to today, that top have not been broken. So my statement back then in beginning of 2025, it was US stock market is going to be volatile because of all this reason. Now let's look at what happened to the US market. We saw that US market went all the way down because of the Liberation Day, but you also pulled back up. But as long as the Q, T, and D is still there, my reading for the US stock market is this year, it will continue to be very volatile. That's my analysis at the start of this year. So definitely you can deploy the CME indices futures to trade or to hedge, especially for the fund managers down here today. Now, let me just share with you one thing here is that on fundamental, something have changed. Now, we could see that Ronald Reagan started this rule-based global order. He coined this idea. Now, in the 1981 to 1989, that Ronald Reagan promoted global capitalization. So it helps, you look at how the market have performed. But it's not only until 1995, WTO taken place, motored by him. Yeah, so he's the man behind this WTO. Yeah, one of the key personnel. But it was on Liberation Day, it changes everything. That we have to understand because of the global order, it brought the US market into its bull run for the last 40 years. But this global order have changed. The whole global order have shifted. So the question is always, is 2025, could it be a tipping point for the US market? And I seriously have to entertain this proposition. It could be 2025, could be 2026 next year. But I think the time is near as we examine all these elements that we have discussed. So we heard that 10 years ago. But I want to say beyond that, it's not the risk I'm referring to. It is the opportunity that I'm referring to. Okay, so I showed you earlier throughout all these sequence, what are the products that's available that CME have carried. I think it helps me along. And let me just share with you this. Could you see that there's two inverted hammer? This is a quarterly chart. The last quarter in 2024 and the first quarter of 2025. And for the first time in history for NASDAQ, or what product is this? Dow Jones. For the first time in history, I saw two inverted hammer on quarterly chart. That also represents, could it be a double top? So we address about the fundamental shift on macro development, but technically, it is also showing me something. And you have not repositioned your strategy, I think, is the beginning of greatness to come. We got to restructure how we manage our position from the past, because I think the opportunity is now. And yesterday, Remark picked me from the airport, so we have a very good exchange in a car. You know, I told him that my wife are very angry with me because when I start investing in gold in 2016, of course now 2016 the gold was about 1,004, 1,006. Of course now the gold is 3,005, and I used my personal fund to invest, and I did not do it for my wife. So my wife very angry with me. So I just told him a story that my wife insists that I should invest and trade using her money. So she also have some stash, personal fund. I told her this. I say now to buy, invest in gold is a bit dangerous. It may take a breather. Okay. So now the thing about trading and investment is this. I bought gold in 2016. It may seem very glamorous today, but you know, sometimes it's very painful. From 2016 to 2020, gold has not moved anywhere. So then my wife, we have a very healthy, we mock at each other. She liked property, but I like gold. But I bought gold in 2016, nothing happened. So she wanted me to buy property. I said, no, I just want gold. So, but now as time passed, there's always delay. We saw how gold has multiplied. So I can tell you that when gold starts to move up, I have two portfolios. One for long-term investment, one for short-term trading into volatility. So since 2020, I hold the gold, that's long-term hold. But 2020, when fundamental shift, when gold started to move up, I start to increase my stake in the short-term trading portfolio. How do I do that? So when you have a general trend that the gold is heading up, my strategy is to buy on dip. So you could consider the CME futures, micro gold, or the 1 ounce gold. So I was going to give you my take about gold moving forward. And I told her that I will not invest in gold for you for long term, but I don't mind to trade, because when I trade, it means that if gold starts to take a breather, I suspect gold may take a breather to about 3,000 or even 2008, then I can get out very fast. But I say that I don't mind to have two portfolios for you in the silver. One for long-term hold in the silver, the other one short-term trading. I'm going to create 2 portfolios for her. That's what I'm going to do for her, because silver, I think the base is still very low. You'll be safer to invest and be quite nice to trade, because that is about $1.50 or $2 range every week. So I'm just going to do this range. Of course, today I didn't showcase the silver product. It's available in CME as well. So when I designed this topic I spoke about risk, but I want to see beyond the risk. To me, every time there's risk, there is opportunity. I hope you are seeing this. So at the end of it, of course, CME sponsored me to be here. When I look at their website, I was so pleasantly pleased that their team is also where risk meets opportunity. I hope that I can someday meet the team who is behind this, the think tank behind CME. And every time when I design a topic for them, I just felt that we're so in sync with each other. So these are the products that's available. You can scan the QR code and you can hedge in agricultural, energy, equities, and there's Forex, where I discuss about it. Interest rate matters, and there's all these micro futures that is available. Okay, last of all, I cannot leave without sharing on my direction about gold. I still like gold. Now, earlier, do you still remember that I shared about Dow Jones on these parallel lines? On the, I think, quarterly chart on Dow Jones, right? You saw that. But now gold have the same behavior. Now, if I'm going to do all this significant bottom, I connect them together, and I parallel it to, in the 80s, the high inflation, and I project it upwards using the same parallel line. I saw this gold meeting the resistance at 3,005, technically. It makes sense. And to me, 3,005 is a very psychological level. Why? Because in 1971, no, I would say this, before World War II to 1971, gold was at 35 US dollars for that many decades. Until Nixon shock, it sends the gold to depart this marriage between gold and the US dollars. So now, from 35 US dollars to 3,005, to me, a psychological level. Why? Because gold have increased by 100 times over the years. It's just psychological. Okay? So now, with this tariff pause, I think the market are pretty happy, especially the investor who invest in America. But the pause is just a pause. It's not a reverse. Okay? Tariff can no longer reverse. It's like a switch. Once you switch on, even you switch back, it's no longer the same. The war has already been declared on the tariff war. It's no longer the same. Now, but the pause is going to bring some positive note to the US stock market, which is dead. But I think the pause is going to bring the gold to move down slightly. So what I'm seeing here is that gold may take a breather to about 3,000 to 2008. I cannot be sure on where it is, but this is what I'm seeing here. 3,005 is a psychological, but in terms of the development fundamentally, we could see that the tariff is on the negotiation ground. So the gold may be taking a breather. But as long as the QT and D still exists, I think gold someday will start to move up. So my plan is that now I want to trade the gold. As the gold continue to come down, for the gold futures, I will consider to sell into strength for the gold. While my long-term portfolio, I'll continue to hold my gold assets. Now come to a time, if we break this parallel line that I've drawn, it may form something like this. Let me just revert back to the monthly chart, and this is what I'm seeing here. It'll be something like this year here, I can't remember which year, maybe 2022 or 23, where if I use the same uptrend channel, place it on the significant top, you could see it kind of take a breather around here. Very brief breather, that's what I saw. And then before I start to break above, sit on top of it, and I believe that gold may range around here before I start to move up here. I think it kind of sums up with the QTD matrix, why I feel that the gold is continuing to move up in the long term, That's why I have two portfolio, one for long-term hold assets, and the other portfolio is to trade, to build up my reserve. So with that, before I end with my presentation, these are the gold available contracts that's available in CME with COMEX gold, micro gold, and 1 ounce gold. So they are margin, but each of them carry the full contract of 300,000 if you buy or sell short gold at 3,000 US dollars. So the micro gold and the 1 ounce gold. So we can get connected through my LinkedIn. My LinkedIn is my name. My surname is Wong. My name is Konhao, Konhw. Would love to connect with you. And the rest are my other information on my YouTube channel, where partially CME also sponsor me to create an insight of the market every week. And that's my personal email address, konhao@wikipedia.com.
Thank you, Mr. Konhao. It is very interesting to learn that inflation actually can be exported, yeah, right,
Yeah.
Pak? We have the pleasure of hearing from Mr. Johannes D. Nugraha, Chairman of ACCA Indonesia Member Panel, Group CFO at Gunung Sewu Group, who will share his insights on the critical topic, weathering the storm, building resilience against climate disruptions. In this session, we will explore how business and leaders can strengthen the resilience in the face of growing climate challenge. Before we begin, allow me to first share a brief profile of Mr. Johannes Nugraha. As a seasoned finance professional with over 20 years of experience, he has a proven track record in both global and multinational companies and local groups. Currently serving as a Group CFO at Gunung Sewu Group since January 2024. Johannes leads the finance IT team across diverse sectors, including insurance, food, and property. Previously, he held key roles such as CFO at Kraft Heinz Indonesia, Papua New Guinea, Vice President at Finance at MAP Active Adi Perkasa, and various leadership positions at Unilever Indonesia and Mondelez Thailand, after 10 years at Kraft Foods Indonesia. Johannes is an ACCA member and holds a bachelor degree in accounting from the University of Surabaya. Without further ado, we invite Mr. Johannes to take the stage. Yeah.
First of all, it's really nice to be here, to be having the opportunity to share with all of you a little bit about kind of a different topic, probably less sexy than the hot topic of geopolitics and the tariffs, or how to invest in gold and all that stuff. Today, I'm going to talk about climate and its impact and how we can prepare for it. So I think when we talk about climate in the last decade, right? Just trying to recall our memories together. What was the last few events that we can recall recently? The one that I can recall very recently was the flood in Bekasi. Right. We in our group we have also we have one property there, a mall, which fortunately was not impacted, but the immediate surrounding was impacted. It delayed the operations, of course, and etc. And what else? I think when we talk about climate, it's not just natural disasters per se, right? We talk also about flood, long drought, and then in my previous company as well, where I worked prior to joining this Gunung Sewu Group, I also worked for another food company, which is Kraft Heinz Global, which is in Indonesia. And there we have one line of product called the canned sardines, Sarden ABC, if you guys have ever consumed one. In fact, actually, for this kind of business, also impacted directly or indirectly. The supply of sardine, for example, used to be very abundant in Indonesia, but I don't know if you as consumers realize it or not. Actually, more than I would say more than 70% of the canned sardines that you eat are actually imported, right? They are imported. Considering that we are one of the largest archipelago nation or country in the world, we no longer have sardines to supply our own local demand. So today we're going to talk about climate and how we both as the business person, business owners, and also as investors, in a way, I would say, or simply as a member of society. What can we learn from the climate and the climate change and how we can prepare for it? So, bit of trivia. Only 20% of businesses overall are prepared for climate-related disasters. And this is a survey done by ACCA, so don't hold it against me. I'm pretty sure it's pretty accurate because the sample also taken from various countries, not just Southeast Asia, but it's also globally represented. So even on a global scale, only 20% of the businesses that ACCA talked to or interviewed are prepared for climate-related disasters. So before we go into the content, let me share the overall findings. Number one is basically the fact that accounting or accountancy and finance people or profession can drive the transformation toward climate resilient organization. In fact, I think that is one of the most influential catalyst for the transformation is in fact in finance. So we should be proud, but at the same time we should be anxious about whether we have done enough or what should we do more, right? Number two, organizations are not prepared for climate-related disasters. Most organizations would have some form of business continuity plan, right? In the case of earthquake, in the case of whatever. But mostly are outdated. They're not updated as frequently as the changes in the climate events itself. Because the climate events also is changing over time. Like how, let's say, the long drought, how frequently it's happening. El Nino is actually happening more frequently in the last decade compared to the previous decade. Right. So number three, resilience is not, unfortunately, not a priority yet on our members' agenda. 2/3 of the respondents in our survey not investing in climate adaptation. Number four, organizations need to consider impact of distributed workforce, societies, and the place they live, digital first approach, must consider also the effect of working from home and the overall employee well-being. And then the last point is that the government and businesses need to collaborate, and it is a crucial factor to balance the climate adaptation and decarbonization with clear policy, data access, etc. Right? We'll talk more about that soon. Okay, so the first one, the following few slides are more on survey results. So this is somehow for our knowledge and also see if it also resonates with your organization, either with the company that you work for or in the company where you invest in. Right, so which of the events can cause operational disruptions to your organization or clients? Which of the following have impacted you? So, in fact, the top four, I think the ones above 30% or 30% or above, mostly are with power outages, supply chain disruptions, which include also sourcing, the manufacturing, and probably also some distribution, right? Employee health and absenteeism, transportation disruption, right? So those are the top four, or probably one more, financial loss as a top five. I don't know how much this relates to you, but, and then the rest, of course, as you go down the list, there are different impacts that have occurred in the organization. So we look at specifically on Asia Pacific. So the thick blue line is Asia Pacific, and the rest of the lines are different parts of the region in the world. In fact, if you look at the general trend or shape of the curve, it's pretty much similar with the global trend itself, right? So the first four on power outages, supply chain disruption, employee health and absenteeism, transportation disruptions are four of the most common factors or variables that is being impacted by the climate change. Now we talk about how well prepared is organizations or clients in addressing and mitigating physical risks caused by climate change and their potential impact on operations. Only 9% is having comprehensive preparation, including the climate adaptation plan. 22% have business continuity in place, but not yet reflected or updated. 38% have some preparedness for business continuity in place, but not fully comprehensive. No plans in place, and don't know total of 31% for both. So I want you to probably also take a few seconds to reflect back on your own experience or on your own organization currently, right? So where you are today in your journey. Do you have some sort of BCP in place? Does it cover also or include the climate change impact into your BCP or not? So 58% of the organization have business continuity plans to address sudden disruption of the organization. If you go down the funnel, 36% have the business resilience capabilities. Go down again the funnel, only 20% is horizon scanning, identifying potential climate-related risks. So basically it's considering, but not yet having a plan in place, nor having the capability in place. Only 17% is doing scenario testing, rehearsing responses to major disruptions. So I would say in my previous experience working for several companies, I would say in this case, Unilever probably is the one that is prepared the most in terms of scenario testing. When I was there, I was involved in some of the scenario testings that we have on the BCP, right? But that was more on the BCP, but not yet the comprehensive climate adaptation resilience, I would say. And 25% no mechanism. So what is the message here? I think this slide is pretty simple. So what do we need to do, or what do we need to invest in? How do we upskill our organization to prepare for this? Basically, the middle part on how to mitigate, how to adapt, and how to transform. These are the three main items or things that we as organization need to prepare, right? And the top icon, which talk about just transition. Just transition is basically process of shifting to a low carbon and climate resilient economy. So it is a process still going, right? With decarbonization as one part of it. But not only that, the whole economy is shifting towards that. So the thing is that with just transition, we need to expect policy and regulation changes. We need to expect market changes, consumer preferences. Like myself, I now prefer driving electric vehicle rather than the traditional cars for the same reason. Social economic impact can be both positive and negative. One could be job losses in high emitting industries, right? So if you have a traditional industry with high emission, probably not right now, but in a few years from now, you might see job losses if the industry doesn't transform. But on the other side, there might be new jobs that can be created which relate to green-related jobs, right, on sustainability and etc. Moving on. So this wheel, I think most of the business continuity plan that we have in place relates to the bottom two, which is respond and recover, right? So basically, we prepare a scenario which particular risks that might happen and how to respond and then how to recover as quickly as possible to resume operations at at a level where we expect them to be. But we lack the top part, which is on the learn, predict, and adapt. Now, this is the part that we need to think in the overall scheme of things, not just about how to resume our operations, but also the long-term trend of the climate, the long-term trend of the change in the consumer preferences and behavior, etc., etc. So why do we need to invest in the resilience? So when we talk about resilience in climate adaptation or climate change, it's not just about the immediate, as I said, right? It's not just about the immediate, what if earthquake happens? What if flood happens? What do we do? But it's also looking at the longer term view of how our business and our business model will shift due to this climate change, right? So when we say that we are prepared for this, then you have the resilience. So, but why do we need to invest now? It's because we can minimize disruption cost. We can enhance customer confidence, for sure, right? I mean, if you're, let's say, if you're supplying agriculture product to your customers, and your customers, let's say you export to Japan, they have a very high standard, right? Or if you export to US, they also have very strict contract about how much you should supply, in what condition, etc., etc. But imagine if, the way we are designing or the way our business is designed and put in place is like all eggs in one basket, one location, no diversification, no contingency. Then if something happens, then we would lose also confidence from our customers. Investing also help us improve risk management practices, ensuring regulatory compliance, for sure, fostering agility and adaptability, ensuring business continuity, and driving long-term sustainability. So another survey. So this is a survey about how perception on the planning for climate adaptation and efforts in to reduce the impacts of climate change, right? So 21% say that investing in these things are additional costs for our business. 29% say it's essential to avoid economic losses. 33% say it's an opportunity. And 17% says don't know or not applicable. I think here, at least, there's bright 1/3 of the pie that talks about an opportunity, right? So we should not only look at climate change as a risk, but it's also an opportunity, right? An organization, a market leader who is not well prepared for the climate change can be displaced by other competitors who are prepared for the climate change. So this is an opportunity, if you can look at it from that perspective. All right, so what do you think about spending to address and mitigate physical risk caused by climate change will look like? Mostly, I think about 37% says it will be increased, but the rest either stays the same or decreased, right? So this is not very encouraging yet. We need more, let's say, commitment on investing and addressing the climate change. So what are the drivers for resilience planning? Basically, what motivates the organization to invest or to plan for resilience? mostly is business as usual during these disruptions, right? So to ensure that something happens, you can still operate as per business as usual. That's the largest motivator, I would say. And then long-term survival of the organization, etc., etc. Whatever your reasoning is or your motivation is, I think it's good to at least consider whether, are you completely free from the impact of climate change or not, right? I think, in my opinion, very, very few business would have zero impact against climate change. Whether you're in agri, food industry, or you're in even one of our subsidiary in Gunung Sewu, we have actually a subsidiary in mining. Even mining is impacted by climate change. How so? Because when it rains hard, it's difficult to do the hauling, the coal extraction. We have a coal mine in Sumatra. So even industries that doesn't seem to have any relations with climate actually is also impacted by climate. If you're operating in fashion industry, does climate impact your consumer preferences? Probably not directly, but I would say it does in certain ways or forms. If not directly changing the consumer preferences, it might impact their income if they work in different industries that are impacted by climate change. So it's a complicated web of cause and effect. So the message here is really, don't take it lightly, I would say. And it's always better to be prepared. But of course, you don't have to invest everything at one go, and you can do your prioritization and all that. I think we have some toolkits that we can share with you at the end, which probably we'll not have time to talk about today. But anyway, I'm going to continue my presentation, and then we can talk about where to get these helpful toolkits. So what is the call for action for our organization? So one is the easiest one that costs no money, hopefully, is to understand and assess your business risks. Unfortunately, I can say with confidence that not all organizations have this, right? The assessment of the business risk. What they have probably is a general assessment of the competition, but you don't have the overall assessment of the business risk from different angles. So if you don't have, this is a good place to start. Number two is embedding resilience in business strategy, meaning that, let's take, for example, the trend on decarbonization, for example, right? If you work in, even like in food industry, it is still relevant that you can claim whatever zero carbon footprint or whatever it is, right? So it's not just to ensure that your business is running as usual, despite all the climate changes, but also to capture the future opportunity. So hence, in your business strategy, when to invest, where to invest, how to develop new product or services, and how to include or embed this climate change into your strategy is another good place to start. And I don't think it costs money as well. Scaling up investment in mitigation and adaptation. Now we're talking about some investment, right? So whatever it is, let's say diversifying your manufacturing operations, for example. Instead of one large mega factory, you might want to look at 2 or 3. I think the principle is the same, right? I mean, like the gold investment we heard earlier, and the stock market and the gold investment. You don't want, like you have 2 factories, but they're next to each other, for example, or the more disconnected it is in terms of the common variable, like whatever it is, it's better for you in terms of reduced risk. Communicating with stakeholders, I think this is also a very important factor. And then finally, advocating for climate resilience. Now, advocating for climate resilience is an interesting point because I think to arrive at the ideal level where the economy or the just transition can happen like in the ideal state, definitely cannot happen just from the internal effort from our own organization, right? We will not have enough money or energy to tackle the climate risks by ourselves. It needs collaboration with the government, supported by incentives, regulations, policies, etc. And we need even our competitors to work together, actually, to prepare for a better climate resilient economy. So being an advocate in this matter is a win for all. Now, for the government, what do you think will happen to government policies designed to transition the country where you work into a greener economy? So the different colors of the bar represent different region. North America is red, Asia Pacific is the blue one, Western Europe and Africa is the green one. Western Europe, the yellow one, and Africa is the green one. So let's look at Asia Pacific in this example. I think most, it's actually the highest out of the all region, that they basically there will be more and more government policies that will come out. And again, the sooner we adapt to this, the better we have a position also to negotiate with the government in terms of fairer, let's say, transition. Because sometimes government can be very abrupt in releasing a new policy, not considering the readiness and the time and the cost required to transition. Right? So the sooner you get into it, the sooner you can collaborate with the government, then it will be better. So the call to action for the government itself is, again, collaboration between governments and businesses. Again, it's very important. It needs collaboration from both sides. Regulation for resilience, implementation of ISSB recommendations, private sector action on climate resilience, data to support business decision making. This means like the data collection and the data sharing as well from the government. How can it help the private sectors in making decisions? And then finally, capacity building for climate action. These are not easy, definitely. It's not a one-year journey. It's going to be a medium to long-term journey, but it's good to start now. Finance, as I said in the beginning, have massive opportunity in playing the role of transformation agent or agent of change in our respective organizations. However, to play that role, actually, there are skill gaps that I think we should all be aware of and realize. Hence, we need some upscaling, value in decisions, data to drive insights, new performance measure, one language, and leveraging our core skills. I think one good way to start promoting a little bit of ACCA sustainability diploma is probably one good place to start. At least designate one or two people from your organization to be certified. That it will give you sort of the overall knowledge on how to manage the climate and sustainability initiatives in your organization, right? But definitely finance plays a key role here. Okay, so finance leading the change in what sense? I think facilitation I mentioned earlier, data quality management, looking at the bullet points on the right. If you experienced, from building your career from the bottom, then you will know for sure how sometimes data quality is a big pain in our organization. I still have that issue every now and then. Reporting is another area where we can contribute. I think scenario modeling is probably the most value added in helping the top management making that decision. And then lastly is the financial planning and analysis, taking the scenario modeling, scenario planning into the financial impact at the end of the day. So where to start, right? Actually, ACCA has toolkits and videos that is free to access. It's available there. Actually, most of the presentation is taken also from that website. Um, you can check it, and I would highly recommend you to start looking at the toolkits and the video resources, which you can actually use immediately. It's quite practical. It's not like it's not very theoretical. It's actually quite practical. For example, on the business impact analysis template, I think this is a simple template that you can use. There are also the crisis management plan template. I've seen it. Again, there is no rocket science to these templates, but it does give you the clarity on where to start and how to put a frame on starting this process, right? So highly recommend you to look at the toolkits. So all in all, at the end of the day, again, it's not as sexy as the tariff topic. It's not as exciting as the gold investment, but it is there. It is impacting our lives. Sometimes we just kind of take it for granted mostly, unless we're the one impacted directly. But what I can say for sure is that whether that's in my previous organization or in my current organization, in my current company that I work for, the climate risks are very, very, very real. So let me close it with a few examples. I did mention about the sardine business, which basically dwindling supply from local, and the fact that 70% is actually imported from Turkey, from Spain, or whatever. And secondly, I did mention and share about the mining business, which is also impacted by the climate change. Just now, I spoke with the GM, with the CEO of the mining business, and he was mentioning that in the month of May, they dropped the production of about, I think, 20% of their average normally, just because of the rainfall. But on the other hand, our plantation business, we are the largest exporter for canned pineapple in the world, in Gunung Sewu. We have a large plantation site in Lampung, and there are some years where we got hit by the long drought very severely, right? So, fun fact trivia: how long does it take for pineapple to grow until it's ready to harvest? Does anyone know? It's actually pretty long. It's 18 months. From the land prep, from the planting to the actual harvest is 18 months. And if you do not identify the climate risk early, let's say, to manage a 30,000 hectares of plantation, right? So just imagine that 30,000 hectares of plantation. You rely on a lot of people, like a lot of labor. And this labor, basically, they might join the company yesterday, last week, 2 weeks ago, last month, or 10 years or 15 years. Whether that's 15 years in the job or just last month joining, actually, they might rely on certain habits that they learned before, right? So, okay, let's say I need to put this much water in the early stage of planting, and this is what I'm going to do for the rest of my life. But the fact that the climate is changing, right, actually requires you to do things differently. For example, one, the land prep needs to be more than the usual, for example, because let's say if it's very dry, then the water won't be able to seep down to the roots. The roots won't be able to absorb the water. So you need better land prep management, not like the usual when the weather is good. And secondly, also the amount of water, the amount of fertilizer, the amount of pesticide that you use, you cannot always refer to the SOP that you have, because the SOP is based on certain conditions when the weather is good. But when the weather is not good, then it's a different story. So imagine that if we ignore these facts, I think it's quite easy to say that more than half of your profit of the year can be wiped out because you ignore the fact that climate is changing. It's not static, right? So all in all, I think my main message is that the risks are there, but also the opportunity, right? The risks are there, but also the opportunity. So start early as possible. Use the toolkit that we have, and hopefully, by the end of the day, you will be able to build a resilient organization. And not only that, hopefully, you will be also to become one of the agent of change, the transformational agent in building a resilient economy. That's it. Thank you.
So, Mr. Johannes, I think your presentation is very useful and relevant for us, the attendees.
Thank you. My name is Theo from the telco industry. Now, my main concern is we understand that ESG would provide costs and additional costs to maintain it. However, are there any opportunities for revenue side in our hope of adopting it?
Thank you for the question. I think it depends, right? What I mentioned is that opportunities will be there. It depends on industry that you're in. I'm not sure if it's telco specifically, but just imagine if you are able to make sure that you have a more resilient infrastructure that is typhoon proof, hurricane proof, probably. There's also one case study in the website if you check it, right? There's one case study in the Caribbean case study. So in the Caribbean case study, I think they also face a lot of hurricanes, typhoons, floods, and etc. Their economy is more than 13% in tourism, right? So one of the, let's say, the climate adaptation and the resilience effort that they put in is actually in building better quality, more resilient infrastructure compared to the normal specs of infrastructure that you will build anywhere else, right? So it may not be direct. For example, let's say in the example of telco and services, it might be your reliability, right? So let's say compared to your number 2, number 3 competitor, if you have your operation still running during hurricanes and storms, it would create a great brand perception for you, turns to be more customer loyalty, and etc., right? So that's an indirect way to do it. A more direct way would be, the easiest example would be in FMCG industry, actually, right? So I don't know if you launch a, probably, let's say the ones that are already existing today, the organic vegetables you see in supermarkets, which costs twice more or 3 times more than the normal vegetables, less pesticide, etc., right? So people are willing to pay. I think the most important fact is that there are groups of people that are willing to pay, that are concerned, that are aware of these issues. So definitely there will be more opportunity, which hopefully can compensate your investments also in preparing for the climate change. Yeah.
I'm Ardo from IPM Institute, and this is my question. I just ran a research on ESG, the impact of ESG, economic, social, and governance. And I know climate change is one of the I think it's included in E, right? And then I found, and I do like a regression model, ESG score I got from Refinitiv database, and I regress ESG as a factor that determines or affects profitability, which is measured by ROE, return on equity, and I found positive impact. So ESG score positively impact ROE, and I treat ROE as like a accounting-based measurement because you can find in the balance sheet and then calculate like rationalize it, right? And then I also regress ESG score on another measurement. I call it market-based measurement, like a Tobin-Skew, like PBV, something like that, and also positively affect what do you call it, the Tobin-Skew. And then my sample is Indonesian listed companies that are listed on the ESG index, something like that. So I can explain how ESG score affect the Tobin-Skew, because it will affect the market expectation, and that's why investor would willing to appreciate more the companies with a good ESG, something like that. But I still challenging to explain how ESG affect the ROE, meaning so it increase the profitability. And you mentioned with your survey that it can investing in a what do you call it, climate change resilience model will save costs, right? So perhaps can be alternative for me to explain. But do you have any alternatives to explain how ESG score increase companies' profitability, especially in Indonesia? Thank you.
Thank you. Thank you very much for the question. It's very, very interesting. Disclaimer though, I'm not a researcher, so my answer is based on hypothesis, based on my years of experience, right? So I think, and do correct me if I'm wrong, it's not a causal effect of ESG score and profitability. So meaning that having ESG score does not cause better profitability. However, I think it's correlated. Meaning, companies who have good ESG score is an indicator that the company is more mature compared to the competitors. More mature in what way? I mean, just imagine if you're running or if you're working in a company that has to firefight every day, that does not have good governance, right? That everything is based on the decision of the weather of the day or what you eat this morning. That is just an indication that the company is probably not well organized. Well, companies who have the time to actually think about sustainability, there's a higher probability that it is more well organized, both from organization structure or even also from the vision of the founders or the owners of the company, right? So that is my hypothesis. I'm sorry, I don't have data to back it up, but I think my intuition tells me that it is not cause and effect, but it's correlation. All right. Thank you so much.
My name is Nur from Pintraco Securitas, and I want to ask about how any institution like ESG implement, because I think I have read some of the news or whatever, the institutional of the US have implemented ESG more deeply, and the outside of the US not so well developed. So what is the view of the emerging, because it's so lately from even the developed market like US, and also US have been exit from the Paris Agreement. So that's what is the future of the outlook of ESG?
Yeah.
Thank you.
Okay, thank you for the question. I think first thing first, we need to be aware that there's a term called the greenwashing, right? So I don't know if you're familiar with that, but basically greenwashing is a phenomena where companies are tend to exaggerate the ESG achievements, right? There is questionable reliability of the ESG reports. It happens in many, many companies, including US. So I think there's a, let's say, more and more effort into governing the standards. Hence, the ISSB actually is released a new standard, right? S1 and S2, which the IFRS S1 and S2, which will be implemented as well in Indonesia, by the way, in the next 2 years, I think. It will come soon, by the way. So the regulation will be there. In terms of the disclosures on not just on ESG like carbon footprint and all that, right? So the standard will not only mandate companies to report, like the carbon footprint, the waste, etc., but it also has interesting questions there regarding the climate resilience as well. So in the events of climate change, what will happen to your business? So there are those questions included in the standards. So I think it's an interesting topic to talk about. I'm still also not yet certified in that subject, but it's an up and coming, aside from AI, which is a very hot topic today. I think sustainability is another one that in the next couple of years will be in high demand because the regulations will be there, right? So again, in making this work, we need both the government and the private sector to work together. It cannot be just the government or regulators, but also the private sector. So I think that's probably all I can say for now. Whether the future is going to be bleak because US walked out of Paris Agreement, I don't think so. I think somehow we will make it better because the threats and the risks are very, very real. And and I think we will have to work together. There's still a lot of homework, right? So don't put yourself as a bystander and waiting for the result. But it's all of us in this together to make it happen. Thank you.
Thank you, Mr. Johannes. Please give Mr. Johannes a big round of applause. Before we conclude today's event, let us hear the closing remarks from Mr. Andrew Lim, Portfolio Head of ACCA Maritime Southeast Asia. Before that, allow me to first read a brief profile of Mr. Andrew Lim. Mr. Andrew is at the helm of the diverse portfolio that spans Malaysia, Indonesia, Brunei, and the Philippines. His leadership is characterized by a focus on critical strategic priorities, leveraging borderless ways of working, a digital-first approach, and fostering repeatable and scalable innovation. His passion for sustainability is evident in his efforts to ensure the long-term viability of ACCA in the Maritime Southeast Asia region. Andrew collaborates closely with regulators, government bodies, and educational institutions to drive sustainable practices and initiatives. Prior to joining ACCA, Andrew dedicated over 20 years to the education sector, where he honed his expertise in strategic planning, business development, marketing, sales, and product branding. His extensive experience and commitment to sustainability ensures the advancement of ACCA's mission in the region. Please welcome Mr. Andrew Lim.
Thank you very much. Good evening, ladies and gentlemen. I'm sure you are glad to hear my voice as the final concluding remarks for today. So just for clarity, the portfolio I handle is a portfolio of markets and not a portfolio of shares or equity or commodities. Yeah. So I manage 4 markets of ACCA, which is forms the pillar of ASEAN, with Indonesia being one of the largest economy in ASEAN, and therefore with ACCA and supporting the agenda of the nation to produce finance professionals and accountants for the country, for the market, to support all efforts. So it's time for me to bring this event to a conclusion, but before I do that, I'd like to thank all of you in the audience for staying in the last 4 hours listening to those very interesting insights, part of buying gold, right? And the sharing, of course, by Pak Johannes on climate finance. And on that note, I would like to thank our guests from CFA Society Indonesia, especially Deputy President Pak Triono. Thank you so much for the support. I'm sure you know ACCA has a global partnership with CFA, and similar events like this are happening globally, whether it's in Singapore, in Malaysia. We have our society in Malaysia, in Thailand, and different parts of the world. And all of us are discussing intellectual discourse on different areas where we can improve. And both ACCA and CFA, we have a joint certification in climate finance, just in case you'd like to find out more. It's available on the website. But if you like some discounts, you can ask Ibu Julia. She can get you some discounts on that. A note of congratulations to our colleagues from the CFA Society and, of course, our ACCA members, our stakeholders, for creating such a powerful and impactful partnership here in Indonesia. And I'd like to draw a little bit on what Pak Johannes has shared and mentioned just now. So what he's shared just now is actually from one of our PI reports, our Professional Insights report, which is available on our website. And very interesting questions from the two Bapak on sustainability, ESG, and the Scope 1 and Scope 2, which is rightly said by Pak Johannes, will be implemented. And those are available on our website. So, ladies and gentlemen, as you know, I think in the past 20, 30 years, the planet has increased the temperature by 0.5 degrees. And what is the result of 0.5 degrees? You get rising sea levels. That's where all your tuna went, swam elsewhere. You have the ocean warming, and you know the ocean is a source of food for many of, fishes and whatnot. We've seen extreme weather conditions, the flooding in Bekasi, where I live, in Subang Jaya, in Malaysia, in Kuala Lumpur. It has never flooded before in my entire life. And that part of where I live is actually quite high. So if that part starts to flood, I think the whole Malaysia will tenggelam already, right? So it's very real. And just before I flew into Indonesia this morning, it rained very heavily, and it was a drought for the last 5 days. And I don't know what happened. Temperatures have soared up to like 38, 39, 40 degrees, which is very weird at this time of the year. So climate is real. It's real and it's happening. And how does organization play their part for people, for planet, and for profit? And together with CFA, we have raised our voice, of course, for greater commitment of climate awareness in terms of businesses. And we have brought all these critical issues as the top of the agenda for policy makers. So 2 years down the road is implementation of Scope 1 and Scope 2 in Indonesia. Malaysia is happening soon. based on the National Sustainability Reporting Framework which will be implemented very, very soon. And there's so much more to come as our alliance, of course, with CFA grows from strength to strength. And basically, climate finance it's an idea where it's everywhere, right? It's throughout the world, and we have to play our full part in making sure the way in which businesses operate takes care of the health of the planet and the people, just as important as profit, as I mentioned just now. And climate emergencies. Again, Pak Johannes has shared a lot of examples about how it impacts production. What I have to say and what I remember from the reports that ACCA produced in terms of the researches that we have done, it may not be a direct impact to services or telcos, but it is basically the entire chain of supply that impacts the entire economy. If one does not do well, it's just like, I think the earlier example, gold prices, buying shares, buying stocks from gold-producing companies. If the entire economy does not do well, I don't think the company will do well as well, right? So just to highlight that. But from ACCA's point of view, we will continue, of course, to advocate for sustainable business futures, which is why we have our professional diploma in sustainability, and that looks at the aspect of sustainability reporting, basically the corporate reporting, and it guides our entire strategy, our education, and our research in the public space. So the report that Pak Johannes mentioned just now is Weathering the Storm, Building Resilience Against Climate Disruptions. You can go to the ACCA website, download the report and have a look, because that is done in consultation with all our stakeholders, members, corporate leaders, students, universities, everyone. So everyone has their inputs in there. So by championing transparency, of course, again, in emission targets and transition plans, finance professionals that is in the country today plays a critical role in reducing carbon footprints and, of course, net zero goals, right? And this is in supporting a fair, inclusive, and climate resilient future. So again, the reports, I won't repeat some of it, but what's interesting is in the report, it says 25% of this organization does not have a mechanism placed to build resilience at all, which means they have no plan. What happens if somewhere is flooded, right? And if you are growing pineapples, right? so that's the example. This is why ACCA and CFA, we are eager to sound this alarm to make organizations understand that they have to make sure that climate is a priority. Again, rising temperatures, I think more intense rainfall, all this evidence that I've mentioned earlier, it's now very real. And I know together with all these issues, we'll be able to solve this. And I'm confident that all of us will make our parts, our responsibilities to ensure that we do the right things for our future generation. So with that, thank you so much for your attention, and to CFA, to all the panelists, very insightful. I go now. Thank you so much for having ACCA as a supporting partner, and have a great day ahead. Thank you.
Thank you, Mr. Andrew, for your helpful closing remarks. Please stay on stage, Mr. Andrew. Mr. Triyono, would you please come on stage to provide the present token of appreciation?
Indonesia Market Perspective for the second half of 2025. second half 2025 will be more volatile compared to the previous years. I think we will see some catalysts that may help the JCI performance going forward.
Definitely it will affect the global trade negatively. And what happened? Currently the S&P 500, the PE ratio is at the 96th percentile.